we're going to wait a few minutes to let everyone kind of join us. We appreciate y'all's attendance. This is our second year of doing real estate online events. Our background is many years of doing events, but just recently, as we all know, the COVID virus has created a whole new paradigm of paradigms and networking. Brian Emerson and I started about 25 years ago doing online, in-person events here in the Texas area. And then Brian branched out and found a great audience in New York and sponsored the New York Private Equity Forum for almost 20 years until he sold it. And he's operating out of Alaska now, and always does a great job, even in such a remote destination. So we have some exciting real estate entrepreneurs today with some cutting edge developments that we're excited to introduce. One thing I'd like to take a moment and point out is that we all are going through a lot of transition in the last couple of years, and it seems to be getting even more confusing as this year unfolds. But one thing is certain is that we're going to have some change over the next year or two, and my gut tells me that it's time for everyone to take a look at their portfolio and their strategies of investing and make sure that they are well diversified. And that's one reason that I believe wholeheartedly in these presentations in real estate, because I think that in times of uncertainty, the characteristics of real estate as an asset class cannot be questioned as far as being able to offer stability. And so for those investment advisors and those family offices and individuals that are looking to rebalance their portfolio, this class is, I think, one that is going to be head and shoulders above the other choices for the time to come. So, okay, well, I think that I'm looking at the numbers. Do you think that we've got a problem with the broadcast? Because we should have considerably more
I think that more people are going to join during the call. As always with these online events, we have some people tuning in a little bit later or tuning in when they're available. So I think that we can slowly get started. Of course, the session is also recorded to allow people who are not able to make it or miss the beginning to watch it afterwards. So this is to facilitate and allow everyone who signed up and expressed interest to view all the presentations. So I think that we can get started, and then we'll see more people popping in the call.
Okay. Well, I was mistaken. I had not fully opened the gallery, but again, welcome, and I would like to start it off by introducing one of our close associates who's been a friend, and he's in the securities business, and he's also an author. And I'd like to give Brad Blazer an opportunity to introduce himself and tell you a little bit about what he's doing.
Great. Thanks for the introduction this morning, Steve. And thank you also, Olga. And more importantly, thank you to all of you around the country that are taking time out of your day to be here, whether you're a potential investor, an advisor, or certainly a presenter. As Steve introduced me, my name is Brad Blazer. I'm a two-time author, author of 2 books that you can find on Amazon. The first one, which was called On the Wings of Eagles, really is a compilation of stories from many thought leaders I've met or worked with in business, sports, and politics, like Joe Namath, former President George W. Bush, Irving Magic Johnson, Kevin O'Leary, et cetera, et cetera. That book, after it was published, quickly became one of the top-rated reads for young entrepreneurs. And we pushed it out, of course, to all of the universities here in the United States that have entrepreneurship programs. And that evolved to radio interviews, TV appearances, et cetera, et cetera. Today, what I do is I run one of the country's largest coaching and mentorship programs called Capital School that really teaches individuals, business owners, entrepreneurs how to attract investor capital, how to work within the family office or the RIA or the broker-dealer space. Over the course of my career, I've been the national sales director and executive VP for multiple sponsors and issuers, and have raised over $2 billion in capital and counting. And so we have students all over the world that are basically enrolled in our program. And today I'm really thrilled and excited because actually 2 of them are right here that you'll be hearing from later this afternoon. Kent, who runs a company called Hickory Creek Capital, and then also Toby and Tebow, who will be talking about their land opportunity investment a little later today. So for any of you that are raising capital or that have an interest in learning how to use other people's money to build, buy, or scale a business, or maybe invest in real estate or finance a project, we've got a phenomenal course that we've put together basically that's broken down into 8 modules. And we teach everything from A to Z, how to put together your investment package that includes templates and scripts to offering memorandums, PowerPoints, investment teasers, all the way how to leverage crowdfunding platforms, how to get into family offices. And, if you're already raising capital and really want to scale and go to the next level, I've put together selling groups, which is basically syndications where we're bringing a community of broker dealers together to actually raise capital for you. So that's a quick introduction about me. I'll turn it back over to Steve and Olga, and I'm real excited to hear basically all of the presentations today and all of the different pitches from the various companies that are looking for capital.
Okay, well, thank you, Brad, and I appreciate your comments, and we look forward to hearing from your presenters. Let's see, Olga, I need your help here. The first presenter, I seem to have lost my menu on the screen.
Yes, no worries. Yes, so the first presenter that we're having today is IGF Green Real Estate. We have Christian presenting on behalf of the company. So if you don't mind, I'm going to share their video presentation right now.
Good morning from rainy and wet California. My name is Christian Heyer. I am the managing principal of IGF Green RE. I'm joined today by my friend and colleague, Robert Elam.
Hi, Christian.
Hi, Bobby. Thank you for making the time. I want to start out with to say thank you to the Startup Club to having us present today at their conference. We're excited to be here and to share our story with you. After the presentation, we look forward to answering any of your questions via the Q&A. Just bear with me for 1 second so I can start the presentation. Our team has extensive real estate experience across different sectors. I would like to point out that this is our second net lease real estate program, and our previous offering, IGF Investment Grade Fund 1, is more of a conservative approach for investors to enter the single tenant net lease real estate investment market. Since its inception, Our tenants have not missed a rental payment, and even throughout the pandemic are paying full rent according to their lease obligations to IGF. This is a testament to our team's underwriting. Today, we are sharing with you our latest offering, IGF Green, with many of the same principles and fundamentals to our previous offering. We're aiming to reduce the risk of investing in the fast-growing cannabis sector while returning attractive returns by securing the investment with the underlying real estate. The properties are cash flowing at the time of acquisition. We do not take development risk. IGF has extensive experience in the cannabis industry and relationships that allow us to build a diversified portfolio across all verticals in the cannabis sector. Often the properties are located in major metropolitan areas. Many people believe, that most cannabis real estate plays are farmland, out up in the mountains, maybe of Northern California. That's not always the case. And also definitely not the case with us. For us, it's all about the location, and we like properties that are located to major metropolitan areas. We are offering attractive risk-adjusted returns, an 8% preferred return, distributed monthly, and a target IRR of 20% plus. Bobby, will you discuss the cap rate landscape and steps we have taken to mitigate the risk?
Happy to, Christian. My name is Bobby Elam, and I'm a licensed attorney and broker in California. I specialize in advising cannabis clients and real estate investors in this sector for the last decade. For IGF Green, we have a 7-layered protection risk mitigation plan. IGF Green General Partner sends distributions out to the limited partners, but they don't take the money directly from the cannabis operator. In between IGF and the cannabis operations is a property manager. The property manager is in contract with a management LLC, which is a profit sharing arrangement routinely found in this industry between the early investors or angel investors and the cannabis operator. Between all of that, we also have a termination provision within our lease. The lease is a 20-year absolute triple net lease, all responsibilities of the tenant. And IGF Green has the ability to break it if at any time we're worried about federal enforcement. But 2020 and 2021 has been a game changer. The Biden administration is coming into power. Kamala Harris is supportive of federal deregulation in this area. The Democrats have taken over both the House and the Senate. The House recently passed the MORE Act. And so it's no longer a question of if, but when we're going to see easing in this sector. And this is the moment to act with IGF Green. In our following slide, we can see some of the returns. You can see the cap rates across multifamily, industrial, office, retail, hotels, and cannabis. The cannabis sector is seeing something around 12.5%. IGF Green has a great pipeline, and we'll see higher than that. You can see that the next best place you can place your money is hotels. The problem with hotels is the pandemic and travel has made them very risky investments. And that's not the case with cannabis because actually they're deemed to be essential businesses in most localities in the United States, which means that they have great stability and fantastic returns. Thank you, Christian.
Thank you, Bobby. That was great. Our team does not only have extensive real estate, finance, banking, and M&A knowledge, but also a deep understanding across the cannabis landscape and operations. Our team's diversified experience and network in this sector allows us to execute our strategy and monetize the opportunity. As a result of the changing perception surrounding cannabis and the high returns we are seeing, now is the time to capitalize on the inefficiencies created by the federal government that still exist today. The cannabis industry is not only recession resistant, but has outperformed most sectors during the current pandemic. We invite you to participate in this offering alongside the general partners of the fund. If you'd like to learn more, we look forward to discussing in greater details and share with you our unique competitive advantage. Thank you for taking the time today to listen to our story.
Okay, thank you very much for that. And we're open for questions if the audience would like to get more information. Let's either unmute or you can send your questions to us.
Yeah, I think the best way to go about the Q&A is to ask your questions in the chat. So please feel free to put your questions down there, or of course during the next presentations, put them down while the speaker is up. In any case, maybe we can invite Christian to say hello to everyone.
Good morning. Nice to meet everybody virtually. Sounds like there were a couple of people that maybe could not hear the presentation, maybe had some audio problems, so I apologize for that. Look forward to answering any questions you might have. Love to dive deeper into our offering.
I have a question about the regulatory environment. Y'all are located in California.
Yes, sir.
Is your operation restricted to California, or would you be able to cross state lines with your enterprise and expand?
Steve, that's a good question. No, so we are looking to build a very diversified portfolio across United States. As long as medical or recreational cannabis is legal, those are the states that that we look to be active in. The diversification is important to us. We don't want to have a portfolio only based on real estate in California. We prefer states with limited license, states that are medical for various reasons. Bobby, anything you want to add on the regulatory aspect of it?
Well, hi, this is Bobby. There's always the concern of single state, multi-state organizations across state lines triggering interstate commerce. And so the federal government has a nexus or the ability to maybe come in and enforce. Having said that, it does make us go towards a larger asset base within a state, typically in a medical license, limited license state, where we can create special vehicles that are specific only to that state. So we are aware of that issue. We actually haven't seen that occur, except only in the limited instance where there might be a state that still prohibits medical cannabis, bordering a state that has fully embraced it. The best example of this is Nebraska and Colorado as an example. If there's a border issue, but even those are years ago. So, but yes, we are prepared to protect on that.
Good, thank you. And how do y'all make money? What's the driving enterprise that generates the revenue?
Good questions. It's through collecting rents, right? So, on the transactions, we currently have under contract, we're averaging 13% cap rate, so that's a nice little cash flow. As we see more, federal regulation, coming online, or maybe better at banking regulations, we expect there to be a cap rate compression. Right now, if we take a like-for-like piece of real estate, the underlying real estate, we see about a 600, 700 basis point difference between a cannabis or non-cannabis tenant, in the building. So we foresee in the next 3 to 5 year hold period, probably maybe 200 basis point cap rate compression. We think that's on the conservative side, but we do provide a nice annual cash flow, just through collecting rents. We do also, in our rent agreements, on average, have a 3% annual rental escalators. But the real appreciation, is through cap rate, compression that we foresee for the next 3 to 5 years. Interestingly, in a lot of our leases, we actually allow for the tenant to repurchase the properties from us, usually in year 3 or in year 5. That allows us to return capital back to our investors early. And at the same time, also when these operators have maybe more traditional access to capital at better rates, it gives them an opportunity to repurchase the property from us at a specified strike price that we agree, through the purchase and sales agreement. So it's a win-win for us in terms of knowing what our exit is, but also gives the ability to our tenant to control the long-term destiny as well. And in the meantime, get to deploy capital more efficiently into their operations. And so, that's kind of the reason we structured it this way.
Well, thank you, Christian. Is this a fund or are these individual units financed in a different way?
Yeah, so this is a fund. This particular fund is a $50 million private placement. It's a 506B Reg D offering. We like private offerings. There's some tax advantages, especially on real estate, that we get to pass along to our investors. And we plan to have multiple of these funds in the next couple of years, as this window of opportunity is still open. At some point, with more federal regulation and better banking regulation, at some point, we're going to see that cap rate compression. And, at that point, we'll probably, slow our acquisitions, hold the assets for a little bit longer, and then start our disposition of the assets probably in about year 4, year 5.
Okay. Well,
I
very
think we
good.
also have some questions in the chat. So maybe Christian, Robert, you can address those. First of all is about debt. What type of debt, if any, is available in your space? And the second one is what is the vetting process for your tenants?
Perfect. So on the debt component, we do have a good banking relationship, a bank that we've been working with for a long, long time. They have offered us to provide debt at fairly attractive rates compared to rates that maybe a cannabis operator would have access to. So right now, our debt, we're looking at probably just under 7%, which is a great rate in the cannabis industry, but obviously still more expensive to traditional real estate debt that's out there. But we foresee us actually buying the properties, all equity, and then putting debt on the assets in year 1, at the end of year 1. It also allows us then to return capital back to our investors early if they so desire. Olga, sorry, what was the second question?
It was about the vetting process for your tenants.
Oh, good question. Look, I mean, people still have this misconception about these operators, right? That they're going to come into your office with a bag of cash to pay your rent. That's definitely not the case. What's really has helped our underwriting in the last 2 years, there's a lot better underwriting information available on these operators. We get to see the tax returns. We get to see the operations. We get to see how they have deployed capital and how they have executed on their business plan. That's critical to us. If there was maybe an infraction in their operations, how did they cure that? How did they fix that? So in terms of the underwriting, there's a lot better data available than 2-3 years ago when some of the operators went public in Canada were able to raise a lot of money, but didn't actually deploy that capital too well, or maybe just have too much debt. Or you might have had a great operator that maybe operated on the black market that now was enticed by federal, by state regulation to come out of the dark ages, but maybe didn't have the experience really to operate in a regulated environment. So, we really get to now pick, the best operators, best in class in the cannabis space. There's just a lot better underwriting information out there that really helps us, be very selective in our process. At the end of the day, it really always comes down to the underlying real estate. Are you buying it at the right price in the right location? But also, especially on net lease real estate, is the tenant strong enough and will he be around long enough to actually meet their rent obligation, right? It's all about the credit of the tenant. And to date, looking at our pipeline, we have strong tenants, great operations, cash flowing well, easy for them to cover their rent obligations to us.
Christian, may I add a few?
Of course.
Few words? My law firm has been in the space for a decade. We have a proprietary list for due diligence that we had to create because we dealt with real estate investors that wanted to engage with cannabis tenants. We've developed that list over a decade. We're very confident about what documents and things we need as deliverables as part of the real estate transaction. And so we know what to look for when we're going in. Having said that, the cannabis tenants cannot just up and move their operations in most instances. They've also put in considerable customized tenant improvements on the scale of millions of dollars. So once they enter into a relationship and a contract with us, they are incentivized to pay that rent, because they can't just move their operations like a hair salon. They need these specialized licenses that are very hard to get, and they are grandfathered specific to the specific piece of property. So we feel actually it's a very stable investment once you overcome the due diligence that is quite necessary for risk mitigation.
Thank you, Bobby.
Well, thank you so much for answering those. Steven, I'm going to pass the word back to you. I think we're at the end of our Q&A, but I'd like to thank the presenter. And yeah, Steven, it's your turn.
Okay, well, thank you very much. Our next speaker is Michael Voda with Dilweg Companies. They're a $1 billion commercial real estate investor.
Steve, can I interrupt you for a second? I think we
Yes.
had a next Rivercross Sports in the lineup.
I'm sorry. I'm sorry. What?
We had Rivercross Sports in the lineup next. Peacock Capital Partners.
Oh, I'm sorry. Okay. Well, then let's. Why don't you take that and let's roll. Thank you.
Hey, I'm Kent Leach with Hickory Creek Capital Partners, and it's my pleasure to introduce you to the Rivercross Sports Complex. Rivercross Sports is a youth and amateur sports destination to be built in Sevierville, Tennessee, and will be the centerpiece of a 272-acre development known as Broad River Landing. Rivercross will initially be comprised of 14 multi-purpose artificial turf, diamond and rectangular fields with a 175,000 square foot indoor facility to be added later. The youth sports industry in America is experiencing astronomical growth, and this growth trend has continued through the Great Recession of 2008 and barely slowed down for COVID-19. The growth is fueled by parents of athletes and their willingness to break out the checkbook and spend on their kids' sports dreams. Many parents admit to spending up to $1,000 per month on elite coaching, training, and travel. In response to this growth, it's not uncommon to see massive facilities pop up in some of the most obscure places, like Westfield, Indiana, or Emerson, Georgia. They believe the saying that if they build it, they will come. And honestly, so far, that belief has proven to be true. But if you survey parents, you'll learn that they know something's missing. Driving an hour to find a hotel room, along with a 2-hour wait at a restaurant, is the norm for some of these locations. The proximity of on-site amenities is the foundation of Rivercross's stay and play vision. It was youth sports that put Westfield, Indiana on the map, and Grand Park now creates a $180 million economic impact with 1.6 million visitors annually. Lake Point Sports in Emerson, Georgia welcomes 1 million visitors a year and creates a $100 million impact for its local community. We've chosen one of the South's favorite vacation destinations, Sevierville, Tennessee, as the location for Rivercross. Sevierville already has the infrastructure, hotel rooms, and restaurants to accommodate our visitors. Tourism drives the economy in Sevierville, and no one does hospitality like East Tennessee. The Great Smoky Mountains already attract over 12 million visitors a year, and 40 million people live within a 300-mile radius of Sevierville. Proximity is a key factor in youth travel sports, and Sevierville finds itself less than 4 hours from these major cities: Nashville, Atlanta, Louisville, Lexington, Charlotte, Winston-Salem, Cincinnati, Birmingham, and Columbia. With the market selected, we searched for the perfect piece of property, and that's exactly what we found when we discovered The Landing. Sized at 272 acres with 1 mile of scenic river frontage and a half mile of road frontage on a 6-lane parkway, The Landing is easily accessible and a perfect home for Rivercross. Rivercross will occupy approximately 80 acres of the site. As the sportsplex is graded and the fields are turfed, the Main Street feel of Broad River Landing will start to take shape as retail, entertainment, hotel, and restaurant sites start to fill in. It will take approximately 1 year to complete Phase 1 of Rivercross, which includes its outdoor fields. Phase 2 will be highlighted by the construction of the 175,000 square foot indoor facility, which is shown in purple, and it should go into service by year 3 of operations. The development team just finished meetings with a well-known architectural firm known as Fugelberg Koch in order to ensure a seamless integration between the two developments. So how does a facility like Rivercross make money? Here you can see a breakdown of year 3 revenues, which is when we expect the facility to hit its stride. If you're like me, I was shocked when I first saw these numbers, but I was pleasantly surprised to find out that they were relatively conservative and derived from similar facilities that are currently in operation. As you can see here, we have 5-year projections with revenues of $8.4 million expected during the first full year of operations. Over 5 years, we expect revenue to grow to $22.1 million, and the bottom 2 lines show our earnings growing to almost $16 million by year 5 and profit margins around 70% by the stabilization in year 3. So what's in it for an investor? As part of our team, an accredited investor can expect a preferred rate of 8 to 10% and a share of 30% of the ownership. Cash-on-cash returns will average 34% over the first 5 years, including the year of construction, which has no revenue. The internal rate of return is solid at 30% with a minimum buyout used to calculate the exit at year 5. Simply put, the cash flow is amazing after its stabilization in year 3. Let's talk about who's going to be making these numbers happen. Rivercross will be managed by Rob Williams, Dave Gillum, and Michael Grade. They have extensive experience in facility planning, design, and layout, as well as event bookings, event operations, and vendor selection and procurement. Each member of the management team brings years of relationships that are vital to booking business for a facility like Rivercross. Michael Grade was the former VP of Sports Operations at Lake Point Sporting Community in Emerson, Georgia, where he was involved in all the aspects of facility design, event operations, sponsorship sales, and the selection of housing partners. So let's sum it up. Rivercross is in a booming industry, a vibrant market, a perfect location, a facility that will be second to none, convenient on-site amenities, experienced management. I'm telling you, opportunities like Rivercross only come around once in a lifetime. From the entire Rivercross team, we thank you for your time and hope you enjoyed learning about Rivercross Sports. For additional information, you can visit investinrivercross.com.
Okay, Kent, thank you so much. It sounds like an exciting project. Where did you come up with the original concept that this would this would work in your area of Tennessee.
Well, Steve, I've got the actual, I've got Michael Grade and Rob Williams on here with me, and this was the vision of Rob Williams and some other guys, but I can let them speak to that.
Great, thank you.
Yeah, sure. Thank you, Kent. Rivercross has been, I guess, about a 5-year project for us. We, as Kent mentioned, Dave Gillum and myself have been working in the sports industry for a number of years. We host softball, baseball. We also run football tournaments as well. And our goal is to provide the absolute best experience that we can to families, coaches, players, obviously, and create a true destination point. And we've experienced this and worked this from different aspects, from players, being players, coaches, and now parents. And obviously, Michael brings a wealth of knowledge and experience in this industry as well. And we're very excited to have had him on our team for at least 2 years, maybe a little over 2 years. And so I'll give him obviously opportunity to expand on that as well.
Yeah, so thanks, Rob. This industry is, as you saw in the presentation, it's a booming industry. It is proven back in 2007-8 to be recession-proof. And as Kent said in the video, even during the pandemic that we're all going through right now, the youth sports market is still just wide open and doing incredibly well. I was involved on the front end of the Lake Point, front end and operations of the Lake Point facility. We were pretty much the first really big facility that kind of broke the mold and has set the tone for other developments around the country that have happened. A lot of people have seen what we did at Lake Point and decided, hey, I could do that, in my area of the country, and let's try and figure out how to do it. There are a lot of private companies and individuals that are doing it. There are lots of cities and states throughout the United States that are doing it as well, because it is such a huge driver of economic impact to their communities. So that's one of the motivations, but it's a phenomenal industry. The numbers look, really good. And I know some of you probably look at those numbers and think they look too good, but that is the industry we're in, and the numbers really are that good. So a lot of ancillary benefits to the participants, the communities, promotes good health and recreation, but it is a huge economic driver for a community and for the owners of the venues.
Okay, thank you, Michael. What is your plan for financing the development of the facility, both equity and debt?
Yeah, we're looking to raise $6 million of equity. We currently have a financial partner. USDA is going to be the way we go. They have streamlined their process for projects like this, so we'll be getting a very favorable rate, and that's the plan for now on financing. We should be around a 5% rate with financing.
Okay, and what can the investor expect as far as the term of his involvement?
Right. Well, with this is kind of a business hybrid, so we had to build in a way to exit the investors. So at year 5, we're going to take a valuation, and we'll be offering buyouts for anybody who wants out of the complex after we value it. At that time, the cash flows are going to be strong. Our hope is that somebody would come in with a 5 to 10 year commitment, but anybody that wants to be removed at that time could be.
Can I jump in? I have a question about the ties with the local community. Do you have any partnerships in place or in the pipeline that you think can make this project a success?
Yeah, yes, absolutely. So the day we open, Kent mentioned it in the video, build it and they will come, and a lot of people take that approach and it does work. But personally, I don't believe in that. I believe in build it and make sure they will come. So we will have a full schedule of events a year in advance or more that we will be marketing. We already have a gentleman that we're hiring that will be bringing 27 soccer events to current events that are being held in other areas that will be relocating to Rivercross. So we already have over half of our calendar filled for our rectangular fields. On the baseball side, we do have partnerships with the largest sanctioning body in youth sports. But fortunately, we have on our staff experts in running baseball events. Myself personally, I've been doing this my entire adult life as a coach and administrator and a tournament director. So we're ready to hit the ground running. So the day we open, we fully expect that our tournaments will be sold out well in advance, and so we'll be going full speed. We did this similarly. I did this at the Lake Point facility. When we opened our baseball fields, our first tournament was 350 teams from all 50 states. When we opened our indoor facility, our first event was a AAU Girls National Championship for girls ages 12 through 18. We had 192 teams, which is the most we could accommodate from 36 states and 3 countries. So we will do the same formula here.
Thank you. Thank you for answering. I think we have still a couple of minutes left for the Q&A. So everyone feel free to pose your questions in the chat. I think we have one coming in right now. Is there any risk of nearby municipalities subsidizing similar facilities and making it difficult to compete?
So I'll take that one to start. So no, we have no concerns. Now, as I mentioned, municipalities all over the country see this as a great way to get into this sports tourism industry and get a lot of economic impact. But what they don't have is the expertise on how to do it and how to run their own events and how to partner with the correct companies. I've been doing this a long time. We have all those partnerships in place. In all honesty, when we get going, any municipality nearby would be crazy to try and duplicate what we're doing, because what we have is not just the sports piece, but the other 190 acres where people literally will be able to walk from their hotels to our fields. They'll be able to stay on site. They can be entertained on site. If they choose to go off site, they can. But we'll have something that is totally unique as far as our industry goes nationwide. Even the ESPN Wide World of Sports at Walt Disney World, they have a great complex, but you have to get back in your car after your game, get out into the traffic, and it could take you an hour to drive 10 minutes back to your hotel. So we have a lot of built-in advantages. But no, as far as nearby municipalities competing with us, I'm not concerned at all.
Okay, well, thank you very much. Any other questions? Okay, well, I think now is the time that I can introduce Dilweg and Michael Voda. Michael is their director of national marketing and has been with the firm for a number of years. They are a $1 billion investment firm, commercial real estate. And I will turn the presentation over to Michael, and I think we have a video to lead him off.
Yes, I'll share a video in just a second. Just want to remind everyone to continue interactions in the chat, of course. If there are more comments or questions, feel free to exchange them in the meantime, and already prepare your questions for Michael.
Good afternoon. I'm Michael Voda, Director of Capital Markets for the Dilweg Companies. Based in Raleigh-Durham, we're a $1.2 billion real estate owner and operator, primarily focused on office product throughout the Southeast. Today, we manage a portfolio of 24 assets consisting of 5.7 million square feet of office product. Over the past 22 years, we have exited more than 80 deals, providing an average IRR to our investors of 23%. The leadership team at Dilweg has decades of real estate investment management experience. We've been through 2 recessions, such as the 2001 tech wreck and the 07-09 Great Recession. And in both cases, we've come out ahead. We've been able to play offense and provide great returns to our investors. Over the past few years, we have focused most of our attention on single-story office product. And certainly due to COVID-19, this has strengthened our position. We have talked to many leading experts that the open air corridors and direct access to suites is preferred instead of going through enclosed public spaces and common lobbies. We believe that single-story office will remain a preferred choice for a number of years and capture a material share of office demand. The Dilweg Company has done these types of transformations in the past and has been very successful in achieving a positive outcome for our investors. One example is Northridge Commons. This is a 7-building office park located on a 38-acre campus in Atlanta's Central Perimeter submarket. We purchased the office park back in November 2019 for $52 million, and at the time, the building was 66% leased. We put $10 million to fully reposition the property by adding new amenities and features, which gave it much more of a creative office feel. The renovations focused on cosmetic improvements, including new tenant signage, modern landscaping, and a parking lot resurfacing. Since acquisition, TDC has moved occupancy from 66% to 74%, and we look to provide a high teen or low 20 return to our investors when we sell. Another example asset is The Exchange. The Exchange is a 14-building office park consisting of 550,000 square feet in Charlotte, North Carolina. The portfolio was acquired in June 2018 for $45 million. TDC saw an opportunity to dramatically reposition the office from a dated office park to more contemporary Class A creative office property that would attract more of your technology, advertising, media, industry tenants. Over the past 2 years, we have executed a $22 million capital improvement plan to reposition the 13 buildings. Since the pandemic, tenants are drawn to space with limited common areas and want the option to have direct access into their office suites. They also like the location of the office park being near high-end residential neighborhoods where many of their company executives live. Single-story product also tends to have greater flexibility around tenant improvements and customizations. The Dilweg Company is currently fundraising for the Office X Fund. This fund will target single-story office product throughout the Southeast. We'll focus both on core plus and value-add assets. The target size of the fund is $35 million with a $200,000 minimum commitment. We expect to close on May 28, 2021. The return profile of this fund is a 16% gross IRR and a 5% current yield paid quarterly to investors. The goal of the fund is to provide diversification for our investors. We've shown you that you can make a good investment in a hot economy, but you can also do very well in challenging times. We hope that you're able to invest with us, and thanks for your time and consideration.
Okay, thank you, Michael, for that. And now the table is open for questions.
Sure, thanks, Steve, and thanks for the introduction.
My pleasure. Y'all done a fabulous job. You look like you have a wonderful portfolio of assets. Are those located mainly in the Southeast?
Yeah, that's correct, Steve. So our portfolio, for really over the past 20 years, we've predominantly focused in the office space. And as I alluded to in the video, we're very much more on the value add opportunistic side. So we're typically buying office product that has a little bit of hair on it. It's a distressed property where maybe it's only 50 to 60% occupied. We can go in, put CapEx into the property, cosmetic functional improvements, lease it up over about a turn of 3 to 4 years, and then sell it to more institutional buyer. And that's really been our bread and butter for the past, as I said, 20 years. Alluding to our track record, we've done very well for our investors. So yes, historically, we've operated from a fundraising standpoint on very much of a direct deal by deal basis. And really over the past 2 years, we focused kind of more attention on raising money for a fund for a few reasons. One, diversification purposes. A lot of our clients and investors have asked us, instead of investing just purely in one office product, I'd like to kind of spread that risk through anywhere between 5 to 10 office properties throughout the Southeast. So to answer your original question, yes, we're predominantly focused in the Southeast. We're based in Raleigh-Durham, so we operate in Charlotte, Atlanta, Tampa, St. Pete, and Nashville. And we're a very grassroots-based company. We have boots in the ground in each one of those areas. Again, as I alluded to, we're vertically integrated, so we do everything in-house with the exception of leasing. So property management, construction management, everything is in-house here at Dilweg.
Okay, well, thank you. All right, no questions. Well, let me ask you this. You say you specialize in single-story office properties. What's the rationale for that kind of strategy?
Sure. So it started about 3 to 4 years ago. I mean, we've always been big believers in suburban office product. And this started, as I said, about 3 to 4 years ago. We kind of focused more attention on suburban, single-story, low amenities, easy ingress, egress for tenants, as well as lower rents. So a lot of our properties we own are in Charlotte and Atlanta, and we do own some properties in downtown Atlanta, Midtown. And a lot of the tenants were kind of moving out towards the suburbs. So a few years ago, we started buying more properties further out, and then we saw an increased demand where tenants were closer to their homes. They had the amenities that they needed at their office property, easy ingress, egress to get in and out of the building. And so we started seeing more demand in this space. And at the time, there wasn't a whole lot of competition because the price point was kind of below the radar for institutional investors. So, it's anywhere between 35 and 50 million acquisition price, and your Brookfields, your Cadres, your larger institutional investors weren't really looking at this product type. So we started buying single-story office. As I said, we kind of put CapEx dollars into the properties, we leased it up, and then we've done very well on that. Now, fast forward to the pandemic, and single-story office looks like the best product type out there. I mean, as we know, and as we've seen in the news, tenants are kind of moving out of the high-rise office buildings in downtown Atlanta or Charlotte or wherever, and they're looking for office space near where they live. Less on a square footage basis over their office suites or office space, and they're also more cognizant of the health of their employees. The high ceilings in the buildings also play a big factor in that. So, with all those reasons being said, we really feel like single-story office is where we see the office sector going, and we really like the Southeast, not only for the job growth, but for the increase in population, especially in Florida and the Atlanta markets. Really over the past year, we're very bullish on this specific product type. And by raising this fund, it's not like we're so diversified where we're shooting with a shotgun. We're more shooting with a rifle. We have a very specific property type in mind. Acquisition size anywhere between, call it 25 to 55 million in price. And we are looking for both core plus and value add property type. we've done a great job of being able to execute on this, meaning we know where to add the improvements for the tenants' experience to be more positive, also push rental rates, and then really to be able to sell this property in about a 3.5, 4-year time period, thus making our investors a really good return on their money.
Thank you, Michael. We have about a minute left. Could you just tell us briefly about the structure of your fund?
Sure. So what we're targeting is a $35 million fund. We anticipate closing the end of May. The minimum investment size is $200,000. It's going to be a 6-year term with 2 1-year extensions. On a return basis, we're targeting a 16% gross IRR, so that equates to about a 14% net, with a 5% current yield paid quarterly to investors.
Okay.
We will have an advisory board for the fund, so our 5 largest investors will have a seat at the table. Each opportunity that's in our pipeline that we're about to close on will have to be vetted and approved by the board. So again, this provides clear transparency between both the Dilweg Companies as well as to our investors. And then I can get a little bit more granular on the splits. So we're targeting an 8% pref and then an 80-20 split, 80 to the investor, 20 to a sponsor. And then the company itself, TDC, will invest up to 5% of the total equity amount in the fund. So we will have skin in the game.
Great. Well, thanks so much, Michael. And okay, up next, we have U.S. Land Acquisitions and Toby Taraki. Toby, welcome.
Thank you, Steve, for making this happen, to you and Olga, and very much appreciate the opportunity to present this information to your audience.
Thank you. Thank you so much.
Pleasure.
I'll be starting to play your presentation right now.
Hello, everyone. How's it going? My name is Toby Tarasi. I'm one of the co-founders and CEO of Invest U.S. Legacy, and we're a real estate land acquisitions company. And here, our mission is to be able to give every person the chance to achieve their version of the American dream through land ownership. We have a pretty unique opportunity by leveraging a revolutionary AI-powered technology that allow us to identify and purchase undervalued land assets, typically between 55 to 70% discounts and resell these properties for an average profit of anywhere between $15,000 and $50,000. Our company, our team brings with them a significant of sales and marketing experience, and we anticipate the first year to generate anywhere between $4 million and $13.5 million in 5 to 6 different key markets where we're currently transacting. The key to our success is obviously going to be flawless execution and purchasing these undervalued land opportunities and marketing them for a significant profit between the $15,000 and $50,000. We've raised so far $1.5 million and are seeking the remaining $18.5 million out of the total 20 in the form of promissory notes, so that we can finance the development of the technology and operations for the first year. All the loans will be backed with real estate collateral of a greater or than equal value to the investment. Our team has experience founding a real estate investment advisory firm that has a turnover of over 130 million, plus has with over 25 plus years of experience from PricewaterhouseCoopers on the client side, and we also work with several industry leaders. So for the loan requests and fundraising tiers, as I mentioned, we are seeking a total funding amount of 20 million. Today, $1.5 million has been raised. And let's see, the remaining 18.5 million is being offered to accredited investors through our company's memorandum. And we will be pledging the land collateral that's going to be equal or greater value than the total investment amount. The loan terms will be 1 year minimum, maximum 10 years. And the contribution is as follows, depending on the tier. So it could be anywhere from 6% all the way up to 15%, depending on the investment amount. This is a breakdown of what the usage of the funds will be for. Land and closing costs, 33% plus roughly. Marketing, operations, and technology, 28%. Salaries, 20%. And we'll have a reserve of about 19%. Hope that you found this information very useful, and I hope that you guys are also as excited as we are, and I'm happy to answer any questions that you may have. Please don't hesitate to reach out. Thank you so much for your time, and appreciate you very much. Thank you.
Okay, thank you, Toby. Do you have some members of your team with you that you'd like to introduce?
Sure. We have Romain here. He's by my side. He's handles the data side of components and market analysis and research. And Thibault for investor relations. He's actually stepped not here at the moment, but he is part of the board.
Okay, well, that's great. Well, I think it's clear that part of your strategic advantage is built around your AI and your information technology. Could you explain a little bit how that works?
Sure, Steve. So basically, we have our in-house proprietary software. We've partnered up with a premier firm of engineers that are partners with Salesforce. And it's an in-house technology, obviously, that it's going to allow us to leverage a lot of big data pertaining to landowners across the country. And so the way we target these individuals is we use this technology to reach out to them and be able to make them a cash offer through various channels, including but not limited to direct mail, social media, and very advanced high-level digital marketing strategies. That's by our fractional CMO. His name is Athens. Athens himself works with a lot of celebrities, influencers that you guys may already know of, such as Grant Cardone, Wolf of Wall Street. So these are the kind of people that we have on our team at the moment, and that's why we project these very ultra conservative numbers of 4 million plus the first year.
Okay, thank you.
I can see also a question. Sorry to interrupt, Stephen. I can see also the question from the chat. Who are your target or typical buyers, and how are they sourced?
The typical buyer, the buyer will be typical developers, people who are like RV enthusiasts, developers, and people who just are looking to, purchase property for one reason or the other. And we make it very easy for them or favorable by providing them the financing that they need. We're having plans to partner in the very near future with a premier credit repair agency in case they don't meet our credit qualifications criteria. But yes, I hope that that will be the vast majority of the buyers. Mhm. Farmers, developers, RV enthusiasts. Yep.
Okay, good. Would you explain a little bit about how the note works? Is there an equity component, or is it just straight debt to the investor?
It would be straight debt to the investor.
Okay.
Yep. And eventually, right now we're in the process of filling four C-suite senior level executive positions. We're doing interviews pretty much on a daily basis, and this is through the help of an executive search talent firm. Once these executives been onboarded, we're thinking of providing pay down some of the debt in return for some equity, so that our investors are well taken care of.
Yep. How would that work? You would negotiate with the note holders?
Yeah, so right now we have some partnerships with a private group of note buyers. So once we purchase the asset, we turn it around to these note buyers, investors, and typically they purchase these notes from us, these contract for deeds, typically between 65 to 75% or so of the principal amount.
Okay, so they would buy the note at a discounted amount, and you would give them a stake in the equity as well to incentivize them, or what?
We have full equity at the moment. We pay them. We use the funds that, when we turn around and sell the notes, we use those funds to pay off our investors first in line.
Right. Okay. All right. Any questions? Talk just a moment about how you go through the selection process of the assets. How does your investment committee interface with the artificial intelligence to make decisions?
Sure, I'll let Romain answer that question. He handles the market analysis and the research component side of things, as well as the acquisitions. Romain.
Hey guys, thank you for having me. So on the data side of things, we partner with the three biggest broker in the US when it comes to property characteristics. And we decided to fully commit to land for different factors. It's way more scalable. And thanks to a lot of tools that we put together and different vendors, we're able to actually make cash offer really throughout the country. And that's the biggest pro that we have here in our company. Using this data, we're able to do some direct mail marketing, but also leverage some type of email campaign, SMS campaign. Everything is defined by our VP of sale that is putting together a really comprehensive sales system to convince those owners that do not want to be owner of their property anymore. There's a lot of different reasons why a landowner will sell for a discount. I mean, I'm sure we saw in the video the deal that we did, I think it was 2 months ago, where this owner pretty much paid taxes on his property for 10 years and never really took the time to build anything on it. And he just decided to sell for a discount. And so our goal here at Investors Legacy is to be able to be aware of those people that do not want to keep their land in their portfolio, and we want to be able to make a no risk offer on the table that could be accepted or not. the statistics here that we have is that for every 100 offer, we'll get 0.2 offer accepted. So you understand that we have to make thousands and thousands of offers through direct mail marketing, through SMS, through emails, to actually land deals that we're interested in and where we can find the most equity. We already know that we make our money buying, and so the rest is just basically put a top-notch marketing strategy to be able to obviously finance those new owners and sell the note down the line when we seasoned it. Does it answer the question?
Yes, that's very good. Thank you. Well, Toby, thanks so much. You'd be commended on a very creative and cutting edge strategy for finding these acquisitions.
Hey, Steven, my apology. Last thing I'd like to mention is that one of the prominent roles that prominent advisors that we have on our team is Mitch Russo. He was a former CEO of Tony Robbins Business Breakthrough International. Mitch is going to be, once we fill those 4 roles, Mitch is committed that he's going to build a national workforce of outside consultants that's going to meet individually with these landowners so that we can present them a cash offer.
Great. Well, thanks so much.
Sure. Thank you for having me.
Thank you. Okay, next we have KL Fund 1. It's a fund created by Keezy Lending, and the CEO, Ken Bloskus, is here with us. And thank you for being here, Ken. We look forward to hearing all about it.
Thank you, Steve. I appreciate the opportunity.
You bet.
Thank you for your attention to our presentation. We are KL Funds Management and Keezy Lending, and today we're going to be talking about a brand new exciting plan for real estate investing, KL Fund 1. We are real estate professionals who have been active in the industry since 1985. Over the last 3 decades, our experience has spanned across land, retail, residential, and commercial real estate. Through ownership in a brokerage, a lending company, and a title agency, we have been thoroughly tackling the Texas real estate market. And not only this, we have extensive knowledge and experience in ownership, management, and sales of $50 million in real estate investments with using other people's money. We have formed KL Fund 1 as a limited partnership with objectives of purchasing and developing quality single-family houses, townhomes, and modular houses for rent. Our sister company, Keezy Lending, allows us to keep funds fully invested by making high-quality, high loan-to-value ratio loans at higher interest rates. As a result, the fund is designed to continually distribute as much cash as possible while maximizing returns. In addition to developing our own rental communities, we plan to purchase single-family houses in bulk and at discount from builders. We are targeting the Texas Triangle, which starts in Dallas-Fort Worth, stretches down through San Antonio, over to Houston, and then back up again. This triangle includes the vast majority of areas that are growing the fastest. Using modular construction, we can build safe, strong houses which reduce the time to market and increase our rent-to-value ratios above market trends. We offer and service 6 to 9 month short-term real estate rehab loans made at higher interest rates. These loans allow us to utilize fund cash immediately, increasing the potential returns. Additionally, our development of houses for rent will allow the fund to have a potentially higher return compared to other funds, while also hedging downside risk. The fund is projected to return a pre-tax rate of over 205%, as well as return all $50 million to investors, despite having an after-cost fundraise of $45 million. Moreover, we have projected an annual pre-tax return of over 39%, with a total projected return of cash of over $102 million. All while the general partners only require a small minimum fee of 2%. We believe that a confluence of events is currently happening, which will create unique opportunities. Our experience in various areas of real estate has allowed us to forecast which segment is rising faster than others. We constantly monitor real-time real estate data to determine and anticipate future trends. National trends show that people are leaving apartment complexes in urban areas in favor of the family life of suburban single-family homes. Numerous publications indicate that single-family housing is in a rapid uptrend projected to last for quite a while. Texas is particularly interesting given these national trends. The data tells us that Texas is the #1 state people are migrating to from other states. This is more than likely because Texas is one of the most diverse economies in the world. It also has a larger economy than Russia and Brazil, even though these countries have 5 to 8 times the population of Texas. Texas is home to more Fortune 500 companies, has way more diverse industries, and has the highest net migration of any state in the country. Because Texas is so strong and is growing rapidly, it allows us to meet our target demographic very easily. The triangle, or the Texas Triangle, is growing to meet 1,500 people per square mile at a minimum of 15% growth. Additionally, Texas has no income tax policy, which is attracting both millennials and baby boomers, which are the bulk of the current and growing rental base. The fund is designed for maximum security, utilizing a low approximate 54% debt. Not surprisingly, this debt ratio will allow the fund to pay the preferred rate of 9%. The general partner is paid a below average rate of 2% per year, or 0.5% per quarter. Typical construction fees are not charged as they are in other funds, so that after all initial funds and preferred returns are made, the general partner will participate in capital gains at a 70-30 split. The estimated good faith projection shows the fund should be capable of making the estimated returns. In addition, the fund will provide some attractive after-tax returns based on estimated tax rates. KL Fund 1 will be utilizing current tax allowances for deductions and depreciation. In addition, the ability of the fund to sell assets based on a net operating income or a market sale of assets adds to the liquidity of the assets. This is in contrast to other real estate assets whose value comes only from net operating income. As mentioned, the principals, experience, unique market circumstances, and high net migration into Texas makes this one of the most opportune times to invest in KL Fund 1. Right now, Texas can add to the traditional real estate mantra of location, 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 and time, time, timing. Thank you for your interest in KL Fund 1. We hope you take advantage of this unique investment opportunity. Thank you.
Thanks, Ken, for that good video. Would you, do you have somebody on your team that you'd like to introduce?
I'm by myself today, Steve.
Okay.
Yes.
Well, I know Ken, and I know his family. It's a family run business, and they've been in business for well over 30 years and do a great job. So we're open for any questions. Well, I have a question on the manufactured housing. Is that a particular opportunity in this economic environment?
Yes, actually it is, Steve. We have opportunities to put in some what we're calling modular housing, and it is not your traditional type of modular housing. This is specialized. We have concrete housing that we can bring in pieces, actually put it together within just a couple of days. Finish out on those houses is typically 30 to 45 days, which from start to finish on a traditional wood frame built house is about 6 months, 4 to 6 months in the same sizing. And especially in areas like down in Houston, when they got hit with the hurricane a couple of years ago and had a lot of flooding in large areas of the city, these types of houses would actually resist that and not be destroyed where other houses were. So that's a unique opportunity we have to do right now in the Houston area, as well as we can put this in other areas of Texas. But the main thing is that Texas is growing faster than basically every other state. We're growing not just from net migration, but we're also adding 400,000 babies a year to the rolls, creating a need for single family rental units. People wanting to move out of apartment complexes into single family, this fastest growing segment of real estate in the country right now.
Right.
And it's a fast growing segment in Texas. Just in the Dallas area, there's over 200 people a day moving into the Dallas area. So the need for this housing is now.
And what is the range in pricing that you're targeting?
The values of the homes are between $200,000 to $250,000, $260,000, and with rents that we could get basically $2,000 or $2,500 a month, $2,000 to $2,500 a month, which is very much in the range of actually getting returns on your money. And with most other real estate opportunities, you take, for example, multifamily. You've got to fill up that complex in order to get, and have a net operating income in order to sell that facility. On this one, when you've got single family homes, the liquidation can either be from net operating income, because there are a large amount of funds out there that will buy. There's investor groups that will buy these houses in bulk once they've been leased up on the net operating income, or sell them out. If the economy were to crash pretty hard, you could still sell these houses as individual homes, so that therefore you've got multiple ways of getting your investment back. So it's a very safe investment, combined with the fact that we're only putting together about 55% debt. It's incredibly safe investment.
Okay. And you are targeting suburban communities in the Texas Triangle. Is that correct?
Yes.
Okay. Could you explain how you're sourcing your products, your opportunities?
Opportunities.
Yes.
We have opportunities that we have sought out some opportunities. Right now we have 5 pressing development opportunities that we can purchase. We have opportunities to purchase single family homes that are already completed. Through our lending company, we come across a number of these houses that investors will go in and rehab, and then they put them back on the market to sell. A lot of these houses are in the market where we're looking at, because we service all over Texas. We can actually purchase those homes from them, and therefore put those into the portfolio as well. From the lending side, the development side, we have several major development opportunities working with various cities in the Triangle to put houses, because they want single family rental units. They're really concerned about their multifamily, and they realize, hey, we need more single family. So they're willing to make some concessions to give us some opportunities to go into places. We've got them in Houston, Dallas area, Dallas Metroplex area, Houston, and then we're now getting into Austin, where Austin is a fast growing area for this as well.
Okay, good.
I can see a couple of questions coming in the chat, so let me just pull them up and group it for you. So a couple of questions about the homes themselves. Are they built on site? What are the materials used? And is there a cost premium in using this versus concrete site built homes?
Well, first of all, the modular housing that we're putting in is a concrete home, but because it's modular, it only takes a couple of days to actually set that up on site, get the shell completed, so that they go inside, finish out the rest of it on the inside, which takes a lot less time to do than a traditional house. Most of a traditional house is the framing, the getting it all in the dry, if you will. And then we also have some opportunities to actually go in for other type, for a little bit lower, where you actually are buying modular housing from traditional modular housing contractors, to be able to put on property, where cities are giving us some concessions because they want some single family rentals. So we have some opportunities which to put in these other modular housing to be able to attract renters and have really nice returns from that.
Okay, very good. Thank you. Now, take a moment and explain the makeup of your fund.
The makeup of the fund is a $50 million fund. We have a 9% preferred return. It is designed to put houses on the ground as well as purchase houses. And we have opportunities right now to be able to go in and purchase new existing product that's actually being built right now. And so the fund will take advantage of those. And these are areas around the triangle, which the people moving in, we're able to get the necessary rent criteria. And if our rent criteria is anywhere from $1.20 to $1.70 per square foot rent, and by us developing these houses puts us at where the cost is a lot lower. So now we have a built-in equity on the houses as well as the rents. So when we go to sell the houses on the back end, the exit strategies sell to REITs, sell to other entities that actually want to purchase these houses, that want portfolio of houses for rent, or a last ditch effort. We could sell them individually, or to even the people that are living in the houses. We have a mechanism. We have a mortgage that could help them get mortgages and things like that. So we have a multiple type exit strategy rather than just one exit strategy. And with the need for housing not ever going away, and especially what we found out last year with COVID, with people wanting to get out of multifamily complexes, going into single family homes, COVID has magnified that. So the opportunity is huge right now for doing this real estate investment.
Okay. Very good. Any other questions? Okay.
And I think we're reaching the time, for the Q&A. So I think we can say great thanks, and thanks for being with us, and we can move to our next presenter.
Yes, thank you, Ken. Our next presenter is another Ken Passanelli with Peacock Capital. Welcome, Ken.
Actually, sorry, Stephen. We also have CityVest. We have Alan from CityVest up next, and we're gonna finish with Ken, I think.
Okay. Very good. Thank you.
Hello, I'm Alan Donenfeld. I'm the CEO and founder of CityVest. We are an online investment marketplace for real estate private equity fund investments. We're raising $2.5 million through a convertible note and warrant offering. Here's a screenshot of our homepage. And as I said, we're an online investment marketplace providing accredited individual investors with access to institutional real estate private equity fund investments with an enhanced investment term. Why real estate? Because real estate has performed. If you compare a variety of different investments, whether it's large cap, small cap, commodities, treasury bonds, real estate has had the highest return over the past 20 years with the least volatility. So regarding real estate, if an individual is looking to invest in real estate, he can buy a condo, he can invest in REITs, he can do a crowdfunded deal, some sponsored deal. It's a daunting task to get through doing his own Argus runs, his own spreadsheets, assessing the risk of the sponsor, the real estate, the environmental reports. Most individuals prefer more passive investments in real estate so they don't have to go through that process. So the first problem is if you look at sponsored deals, they typically charge fairly high fees and they have not performed. They're individual asset investments, hard to get a lot of the information that you need to assess those deals. If you look at REITs, it's great that they're liquid and public, but they typically have underperformed with a 2.5–3% distribution these days. Crowdfunded deals have also not performed due to adverse selection. They're also predominantly individual asset investments. Real estate private equity funds, on the other hand, have performed phenomenally well, generating in the teens and 20s over the past 20 years. However, because the very best ones are quite large, there's a high minimum investment, oftentimes $1 million or more. CityVest solution is through our website, which is a fairly easy and simple way to click and look at various investment products. We aggregate our investors into feeder funds so that we can then invest that pooled capital into that real estate private equity fund, which has many advantages, not the least of which is them being a institutionally focused fund, which means there's usually a key man life insurance policy, an administrator, an auditor, and then investing through CityVest, we have a low minimum, highly selective, fully vetted transactions. The key is that we invest like a big fish, which means we do the due diligence to find institutional funds which are the best performing. However, those best performing funds typically have $1 million minimum subscriptions, so a little bit out of reach of a normal investor who might want to invest 25, 50, even 100,000. What we do is we will aggregate our investors together in a feeder fund, which we call an access fund, and then given that our total aggregate pool is $3, $4, $5, even $6 million, we're able to negotiate better investment terms from that underlying fund. So we provide a number of benefits for our investors, including investment monitoring, portfolio diversification in the funds. The passive returns generally have been 10% on the debt side and up to as high as 25% for a preferred equity investment. As I said, these are institutional quality with administrators, auditors, key man life insurance, and a past audited track record. Here's the 12 access funds that we've done to date, and right now we're in the market with McFarland Fund. The traction that we've gotten is about $400,000 of recurring revenue over the past year during the pandemic, closing 6 investments, and we have several lined up for this year already. Our revenue model is that we make 1.75% as a recurring fee based on assets under management, and we earn upfront listing and organization fees. There's a big pool of investors, 12 million accredited investors, and we have a solid marketing team reaching out to those investors. Here is our management team, including my CTO, General Counsel, Director of Marketing, Investment Advisory Committee. We're raising $2.5 million for a variety of purposes that I'd like to tell you more about. Thank you very much.
Okay, thank you, Alan. And do we have some questions on their investment strategy or their fund?
Maybe Alan can tell us a little bit more about the use of the funds since this part was shortened at the end.
Sure. Can you hear me, Olga?
Yes, perfect.
Okay, great. So we're raising $2.5 million through a convertible note and warrant offering. The convertible note is convertible at a discount to the next round financing valuation, 25% discount. We're paying a 12% interest rate on that note, and there's also warrants attached for further upside. The use of the $2.5 million is to employ a real estate celebrity as a influencer that we would use throughout our Facebook and YouTube advertising and LinkedIn. We have some website upgrades that we like to do, and then we like to expand our marketing throughout digital media.
Got it. Thank you. And also a couple of questions from my side as well. You spoke about the traction that you got in 2020 in the past year about the profits. What about the users actually? How many users do you see on the platform? How many of them invested? What was your experience like in the past year?
Sure. So we've been marketing for a couple of years. We have about 5,000 registrants on the website, about 500 actual investors in each of our access funds, which then invest in an underlying fund. We get about 50 to 70 investors that are prior investors, investing anywhere from 50 to 75,000 each, and then 25 to 50 are new investors that come to us through our marketing. So on average, investments have been about 50 to 60,000 per investor. We have about 100 investors per access fund. So we've been investing around 5 to 6 million in each underlying fund.
Got it. I can see a question coming from the chat. What are your preferred markets and sectors?
You know, it's hard to say. I think it's very fund specific. So we ourselves are not investing the capital. My job is to review 700 real estate private equity funds and find the best strategies. So right now we're working on a distressed senior living acquisition fund. They happen to be located in Texas. I do like Texas, but if their strategy was focused in another state, that would have been fine also, as long as they had the expertise, audited track record, and the other ingredients that institutional funds have, the auditor, administrator, Cayman Life Insurance, investing at least 500,000 in their own fund, and passing various tests. We have a third-party due diligence firm that writes a report that's available on our website. So this current fund happens to be in Texas. Prior to that, we were marketing a GP co-invest fund that we did invest 6 million into them. They're actually nationwide investing alongside CA Ventures and a host of other sponsor funds.
Okay, thank you, Alan. Who is it that vets your investment opportunities? Do you have an investment committee, or how is that decision made?
We do. It's led by me. There are about 700 real estate private equity funds that raise capital each year. We review each and every one of those 700, and the list gets whittled down extremely fast because every underlying fund that we've taken on has net realized net of fees returned to investors over a 20%. So we all know that the last 10 years for real estate has been phenomenal. And for most funds, if you have not been able to achieve something over 20%, that would not be on our shortlist. So it comes down to a very limited number of funds fairly quickly, not just from that rate of return, but also passing the numerous other tests of having a prior audited track record. So if it's a first-time fund, we don't take it on. If they are not investing at least 500,000 in their own fund, we don't take it on. And then after we do all of our vetting and it goes through our committee, then we have a third-party due diligence firm that writes up a report, and they do all the background checks, drunk driving, liens, any lawsuits, all of those things is done by a third-party due diligence firm.
And how is the mixture of your fund? How many different funds would you include in your managed fund?
So it's not a fund of funds, it's a fund of funds. So we create a feeder fund to invest in one specific underlying fund. because those funds typically are raising around 100 million. Their minimum investment size is $1 million, and that is out of reach of most individual investors. We create a feeder fund, and our investors invest on average around 50,000, although we would go down to 25. And we aggregate that pool of capital. We then invest in that underlying fund because we then represent 5 or 6 million. We're able to get a 10, 12, and in a couple of cases, we got a 14% pref and usually a lower fee because we then represent such a large investment size in that underlying fund.
I see. Okay, very good. Okay, well, thank you so much, Alan.
Can I just ask one more additional question before we move on? Do you work only with US-based investors, or are you also open to foreign users?
We are open to foreign investors, both on the fund and in CityVest. It would simply be through a Reg S private placement rather than a Reg D. So we're open to all investors.
Okay, got it. Thank you. I'll pass it back to you, Stephen.
Okay, well, thank you. Well, I think that we're down to our last presenter. Thank you all for staying with us, and so I guess we are ready for Peacock Capital and Ken Passanelli. Welcome, Ken. Thank you for being here.
Well, thank you so much for having me, Olga and Steve and Brian. I appreciate all the previous presenters. I've learned a lot already today, and so it's not my intent to keep anybody for a very long time. I appreciate everybody being so patient through the other presentations. I'm happy to present our multifamily fund. We are a fund that's focused on acquiring, owning, and operating multifamily real estate throughout Central Florida. Much like the prior presentation on the Texas Triangle, we are very focused on the Golden Triangle of Florida, which is an investment area from Tampa to Orlando to Gainesville. That geography defines some of the top intellectual investment in the state of Florida, with the University of Florida being the #1 research university in the state, the University of South Florida being the #2 research university in the state, the University of Central Florida being the #4 research university in the state, and then a tremendous amount of research and development, both military-based and civilian, from Tampa all the way out to Cape Canaveral. Our strategy is to specifically target Class B and Class C multifamily. We are targeting communities that operate at 150 units or less, typically neighborhood communities that the large institutions don't pay attention to. We are also developing selectively at that same scale. In many respects, similar to what you've heard, we have a concept that allows us to build quite a bit faster, but all the same idea, which is to target Class B and Class C. Our developments are to a Class B standard as well. The geographic focus gives us a couple of competitive advantages, which is we have some tremendous relationships in those markets. So both in terms of existing owners and also the brokerage network, which is so important, even in a quote unquote off-market opportunity. We found that using skilled professionals to leverage those relationships gets us a much better result, both in terms of final price and, more importantly, certainty of execution. So we're focused on that triangle. The other part of the component in terms of why we're focused on that triangle is our resident profile is focused on people that are making between 60% and typically up to 80% really, and 120% of area median income. It's actually the widest part of the housing need in the United States in general. It is certainly the widest part of the housing need in the state of Florida. And while there has been a focus on affordable housing with a capital A, that is housing that's somehow subsidized, and we expect with the change in administration to have a significant increase in low-income housing tax credit housing. And there's certainly been a huge focus at the upper end as people rush to build luxury Class A, highly amenitized communities. The part of the market, the broadest swath of the market that can't afford the upper rents and make too much money for the lower rents is being ignored because of two forces. One is market forces, in the sense that any value add guy is going to buy a building and then move rents and make those apartments unaffordable for that same income demographic. or NIMBYism, where escalating land prices and, more importantly, escalating entitlement development costs are forcing product up the stream to Class A product. The same municipalities that are often bemoaning the lack of affordable housing are the same ones that are adding tens of thousands of dollars of development cost, and that continues to force housing to become unaffordable for most of the people who are working in that space. If you follow the same 30% rule that has been the kind of the federal nominal standard, a couple making $50,000 to $70,000 a year can easily afford the housing that we buy and the housing that we built. We also have a long-term strategy. So our focus is on owning and operating. By long-term, we mean long-term, it's an evergreen fund. Our return of capital happens via refinancing events and via operating cash flow. We're very focused on good operating cash flow. Net operating income certainly drives the value, but also that cash flow is important in terms of maintaining discipline. And the advantage to that is real estate, as we all know, is a very inefficient process, both from a transaction standpoint. Buying and selling real estate tends to be relatively expensive. And on a tax basis, a sale is expensive too. So the advantage of receiving a return of capital via a refinancing event, which is obviously not a taxable event, and then operating cash flow, which is appropriately sheltered via cost segregation and other methodologies, allows you to get an after-tax return that's quite significant. And you get a return of invested capital while you still own a pro rata share of the cash flow going forward, and also have a real equity interest. So you truly get to have your cake and eat it too. We have 3 projects that are currently underway. The first one we've closed on recently, which is Georgetown and Cynthia Gardens in Plant City, Florida. Most people don't pay attention to Plant City unless they're buying strawberries. It is now part of suburban Tampa. We bought in a location that is about a 20-minute drive to downtown Tampa, a 15-minute drive to downtown Lakeland, and most importantly, 1-minute drive from the front door to I-4, which is the main transportation infrastructure throughout, and that is where value gets created, is being close to this transportation infrastructure. So the plan is very basic. The property was owned for 40 years by the original developer. He passed away. His children, his 3 daughters, were managing it for the last 5 years. They decided to sell. We were able to acquire it. We actually acquired it at not the highest price. There was another offer that was competing with ours, but we acquired it directly. And even though there was a broker involved, and part of that presentation was the fact that we are going to continue to build out. So this project has 104 existing units that haven't been renovated since they were built in 1974. We're also getting vacant land with the project to allow us to build 58 additional units as part of the fee already entitled. And so the plan would be to complete that development. In addition to that, there's an adjacent parcel we now have under contract that will let us build another 40 units as part of the overall development. And so we'll take this from approximately a 104 unit building to a 204 unit building. The second project is a project we currently have under contract. We're closing in the next 30 days. This was actually bought by a large fund, an institutional fund. They bought it in 2016, did a very significant interior renovation, did a great job with it, to be honest with you. Truly, truly terrific. They refinanced it last year with the Freddie Mac loan, so we're doing a Freddie Mac assumption. This is a project, it has 100% one bedrooms, so that scares some of the institutional players on the exit. My partners and I have operated in Orlando for over 20 years, and predominantly one bedrooms. And in a post-COVID world, much like families are moving to single family rentals, we heard earlier, in a post-COVID world, from a multifamily perspective, 1 bedrooms are in much higher demand than 2 and 3 bedroom floor plans. So in addition to our experience, we don't have any trouble operating. The value add play here is to simply finish the mission. We will upgrade the exteriors, we will upgrade the amenities, which were not touched at all. And then we will directly market to the 2nd largest hospital installation in Central Florida, which is Orlando Regional Medical Center, which is about 1.5 miles north of this location. There are several brand new Class A buildings that compete with rents that are $400 to $500 per unit per month higher than our pro forma target rents, and are currently $600 to $700 higher than the existing in-place rents. The third project, and it's an interesting part of the fund, and it's why we're actually in more of a fund model than individual direct asset model, is a brand new construction in Wildwood. For those of you who don't know Wildwood, Wildwood is a suburb, hard to imagine at this point, but a suburb of the Villages in Central Florida. The Villages is still the fastest growing zip code in the United States. The challenge there, of course, is that It's age restricted to 55 and older, and there's really no market rate housing anywhere nearby for the people who provide services in the villages, including typical what you would see first responders, teachers, retail establishments, all of those sorts of things. And so we are designing something that is targeted to that demographic. There's huge demand right now. The average commute for that population is about 40 minutes, and we will be less than 50 minutes. So that's the play there. The advantage of this model is that we are acquiring income producing assets in real time with development assets. And so on a portfolio basis, we get the blend of current cash flows, future cash flows. We mix location, we mix size of asset, and we mix age of asset so that we get a reduction of overall risk and an improvement of returns for the investors. There are a couple of other case studies we can go through, but as I mentioned, my partners and I have been doing this since 1999. We launched on our own in 2016. The first building we bought, was in Orlando, 42 units. In 18 months, we returned 100% of the invested capital plus a preferred return plus operating cash flow, and the building's producing operating cash flow for investors right now. Second one is an existing deal in Gainesville, Florida. We're about to complete. We bought it as an 82 unit project. We're adding 18 units on some additional land that was part of the acquisition. We will take that to a HUD 223F mortgage this summer when we finish the new construction. That new construction is going vertical right now. And the last case study we have is a fractured condo. In previous life, we bought 3,300 units of fractured condos. In our current round, we've acquired 30 of 32 condos. In this project, we'll buy 2 more. We also acquired raw, entitled, and improved land, actually, to build an additional 75 units, which we will start construction on in April. When we finish and lease that up, we will have a 107 unit project that we will permanently finance and return all of the capital to our investors. So that is the model and the fund. I'm happy to answer any questions or talk any more about kind of structure and split and all those sorts of things if there's an interest. Thank you.
Okay, thank you very much, Ken. That was very impressive. And how large is your team that does the management and construction?
Oh, perfect. No, it's a great question. So the management, we are currently using third-party property managers. The reason for that was quite specific. We made a conscious decision to grow our asset base separate and distinct from our management base. Again, in our previous life, I personally built an apartment management company from 0 to 20,000 units, mostly for special services and workouts. And so we did that over a span of 4 years. We're capable of that scale, but I wanted to make sure we were buying good quality assets first. On the construction side, we have a design team and a construction team, again, third party, but inside the family, if you may. An architect we've been working with for 5 years, a construction company that's actually a relatively young construction company. They're 3 years old, but very technologically savvy and on board with our construction model. Our construction model is simple, which it's no different than a limited service hotel or a QSR, if you may. We just build a building. We don't build anything else. And so if the site supports the building that we like to buy or like to build, we build it. And if it doesn't, then we don't buy the site. And so they've become very adept and very efficient at both the construction technique we're using and the model that we're using. And so there's very little deviation, there's very little waste, there's very little slippage because we are using the same general and then the same subs on a repetitive basis, which is also an advantage of our geographic span.
Okay, and how far geographically do you go from your headquarters?
Well, right now we are really focused on that triangle. So I can drive to every building that we've bought and every building we currently have under contract. We own 18 buildings. We have 4 more under contract right now. And every building we're developing, and we have 6 sites under contract right now, within 2.5 hours. And so I'm headquartered in Winter Park. My partners are as well. We all live right here. So Orlando, if you may. And so we can get anywhere in 2.5 hours. I'm not as big a fan of the Space Coast, I'll be honest, because it's been a little bit more boom bust, although fortunately for all of us in Florida, it's been a huge amount of boom lately. And in South Florida, the problem is there's a ton of money and a bunch of really, really smart people. So we don't compete in Miami-Dade, Broward, Palm Beach counties because there's a lot of really great real estate people there with a lot of capital. And so we're not competing in that space. And we also have plenty of opportunity in the triangle I described, which 150 units or less. We fit into neighborhoods. It's a different approach than building in a greenfield. And so, we have opportunities in front of us without getting too crazy on the geography.
Okay, all right. And would you explain your fund or the investment vehicle that you're using for this?
Sure. So our first 18 deals were all individual, typical syndication that everybody would be familiar with. We actually had a number of investors who said they'd like to diversify risk away from just a single asset investment. And so we put together a fund to combine both the existing income producing properties that we acquire and then the new development. We pay an 8% preferred return. It's a traditional European waterfall. So we're paying an 8% preferred and we're returning 100% of investors' capital before any of the sponsors participate in the cash flows. We're also very, very fee light. We focus really hard on being perfectly aligned with our investors. We do not charge an acquisition fee, a finance fee. We have a slight asset management fee in the fund model just to cover fund expenses while the capital's out, but it goes away once all the capital has been returned. There's no ongoing asset management fee. We don't charge a disposition fee, although the intent is not really to sell, but if we did sell, there's no disposition fee. So 100% of our participation is on the real estate cash flows, and 100% of the participation is subordinate to the investors getting all their money back. And so we really are shoulder to shoulder to make sure that we're performing and doing what we said we would do in terms of returns, and then also making sure everybody gets a return of capital.
Well, great. Well, thank you.
Thank you.
Any questions from our audience? Okay. And again, what's the size of the fund that you're trying to raise?
$40 million is the capital raise.
Okay.
We have assets already committed that would put out 25 million of that today. So we're not intending to sit on capital for long periods of time. We're very specific in deploying that capital quickly so that we can get returns and get capital back.
Okay. And the unit size?
Our current request is 100,000. We can do as small as 50,000, no problem.
Okay. Very good. Okay. Any other questions? Olga?
Well, not any immediate questions from my side, but Ken, thank you so much for joining us and for the presentation. And I'm sure you're going to have many more great follow-ups with the investors that we had with us today.
Okay. All right.
Thanks, everyone.
And Steve, let me take the floor for just a second. We have a last minute, nonetheless, quite exciting addition to the lineup. We have Ward Ozaeta from One Property Group with us today, and he's going to be actually concluding our presenting lineup. So Ward, I would like to invite you to say hello to everyone and maybe share your screen for the presentation. Ward, are you able to share your screen?
Yeah, I'm here. Can you guys see me, hear me?
Yes.
Yes, perfect.
Welcome.
Thanks, guys. Give me a second here. Let me share my screen with you guys. So, Brian, thanks for following up and inviting me. I know this was kind of rather last minute.
Glad you made it, Ward. Very exciting you could join us. Thank you.
Yeah, I know this is rather last minute, but as the saying goes, if it wasn't for the last minute, a lot of things wouldn't get done. So, you know, this presentation is going to be rather short and pretty, you know, to the point. It won't have, you know, a lot of the other information that the last presenter may have shared. So I'll just kind of get right on with it. So One Property Group was started by myself and my business partner, 30 plus years in the industry, managing a multifamily, doing value add and institutional quality assets. My background has been in the brokerage community, 10 years in the Marine Corps, 15 years in the brokerage community and financial advisory with a background at Northwestern Mutual. And over about a year and a half ago, we got together, put our heads together to kind of discuss, you know, the option of acquiring assets versus just providing third-party management, construction and value add plays. And so we decided we'd leverage our expertise and get into this space. And so about a year ago, we started the effort to look at opportunities. We currently have 2 deals in escrow and a third on the way. If time permits, I'd probably get into that deal that we have, one of those deals that we have in escrow currently. But I just at a high level, just want to run through what we're about. One Property Group, our philosophy has always been about people at the forefront of what we do. And what we do is bring together people, capital, and real estate to really
Ward,
create
I'm
value.
sorry to interrupt you, but on my end, I see a black screen. So I'm not sure if you're sharing any slides at the moment, but just wanted to double check that.
Oh, I'm sorry, guys. Is it not showing?
No, it's not.
Yeah, it's
It says-
black on my end. Yeah.
Okay, let's do something about that.
It says we are viewing your screen, but it doesn't, it's not showing your PowerPoint. There it is.
Okay.
Okay.
Yeah, we can see it now. That's better.
Okay. Is that better?
Yes. Thank you.
Okay, good. Our focus is on delivering to consumers a quality living space. We believe that everyone should be afforded the opportunity to have a quality, up-to-date, 21st century technology-enabled living space that's affordable and sustainable. And overall, we want to create and renovate properties that are sustainable properties. The market size, everyone's pretty much aware of the size of the market. It's about a $4 trillion market space, over 20 million in multi. We think that everyone is if presented in this space can play in. We just want to do our part. One of the problems we think that is important for us to solve outside of the red tape and bureaucracy that we typically go through for affordable housing is to be able to find a way to solve affordability in this space. There's a tremendous amount of housing stock, about 40 million folks in the United States rent. And we think that because of the need for renovation over the next, I'd say between now and 2030 of about 11 million in units to be rehabbed, that there's a significant opportunity there. We feel like the opportunity to preserve units is a strong play versus replacing units, since on average about 100,000 units are either obsolete or demolished every year. And so we think there's an opportunity for us to play in the space to preserve some housing stock and create housing affordability for folks that are renting. At the same time, we see that most of the institutional quality asset goes to institutional players, and about 5% of individuals get to participate in institutional quality assets. So this is, for us, an opportunity, a problem we feel like we can solve and present and make accessible to individual investors as well as institutional investors, institutional quality assets. Our strategy, our solution getting into this is threefold. Acquire and reposition assets, making them, bringing them up to 21st century on a tier level. We want to also be able to create a multi-brand strategy within the segment of properties that we renovate, whether it's between it's 1979 and older, if it's 1980 to 2000, or if it's 2000 and newer. We want to create 3 segments or tiers within that niche of housing. And so we look at an affordable brand, a market brand, rate brand, and a luxury rate brand. Some of the competitors in the marketplace that are more prominent that you might be aware of or may not. The top REITs in this space, Aimco, UDR, Camden, Essex, and then some of the more recent players that are more focused on investment acquisition, Cadre, Fundrise, iFunding, Brickvest, bring kind of a more platformish type play to the industry. We want to merge the two as we continue to grow and build out our effort and bring accessibility to opportunities through technology, leveraging technology, and also bring our level of expertise and deal flow access to the opportunity as well through traditional channels, that be brokers, owner relationships, and other institutional players that we have relationships with in the industry. The team has been around for a while. As again, myself, been in the industry itself for over 18 years in the financial service industry as well. And my partner, Dirk Needham, has been in the business for 30 years. His sole focus has been multifamily operation and management and construction. And then our acquisition, director of acquisition and finance is Craig. Craig's been in the business for some time. He was most notably with Realty Income at one point, and as well with Bank of America some time ago when they had a $2 billion fund that they operated out of. And then our in-house counsel and director of urban planning and development is Barry. Barry has about 25 years in the industry, currently sits on a couple boards with the city, local cities and municipalities here in San Diego County and Imperial or Inland Empire in Riverside. And that's it in a nutshell for us, guys.
Oh, great. Thank you so much for the presentation and for sharing with us your exciting journey. Stephen, do you have any questions that you'd like to ask?
Yes, I was wondering what's the target area that y'all are seeking to find your investments, and how far do you reach, and is it very limited to your strict criteria of investment?
Yes.
Property.
So our current target market involves primarily the Western Sun Belt, which will go from essentially Washington down here to Texas. Southern California is where we're based out of. So a lot of our energy and time and effort is spent in California, up and down the coast. But we'll also go to markets like Utah, Colorado, and some pockets in the Northeast, where we think there may be strong barriers to entry and high cost of living. So our primary focus, however, is going to be on the Western Sun Belt.
Okay, and property types, what's the range and diversity in that?
So our range is going to be anywhere from 50 units to 250 units. We'll try to stay under the radar for most institutional buyers so that we're not competing with REITs, many of the top REITs of the world. And so we think that sweet spot can garner us tremendous success. And we've actually been drumming up tremendous deals. As I mentioned, we currently have about 232 units in escrow. We have another 100 units that we'll likely put in escrow shortly, and we're working through not due diligence, but the financing on those projects. One of those financing on the larger deal is a Fannie Mae loan, and so we're working through some of the hurdles and challenges we need to deal with as far as assuming that loan and closing on that deal.
Okay, and again, go through the structure of your investment fund or the investment vehicle.
Sure. So most of the assets we acquire will be in single purpose entities. One property group is C Corp as a parent holding company, and most of our projects will be managed by a GP, and will usually raise capital through a two class of members, Class A, Class B. That may evolve as time goes on and as our institutional partners grow. But typically, we will kind of keep it as simple as we possibly can. And if it's required that we go to another structure as a TIC structure or TIC model, then we'll adapt as necessary. But for the most part, we're doing our best to keep things as simple as we possibly can keep that.
Okay, very good. Thank you. Any other questions?
Could you tell us maybe a little bit more about financing of one of your upcoming deals, and also what would be the minimum, say, entry for an investor who wanted to join you?
Sure. So the minimum investment for two classes of investors. We have a Class A, which is for anyone investing under $1 million. The minimum is $100,000, and again, we can adjust that as to a lower amount as necessary. But the minimum check amount is $100,000. If you're investing $1 million or more, you'll be investing in the Class B member class, which gives you opportunities to vote and be involved in decision making with regards to assets. And also, we're targeting that class of investment primarily to larger or institutional type investors. So in the first project that we currently are financing, we're raising about total of 18 million in equity. 90% of that, we would prefer to go to an institutional player or high net worth individual that prefers to be a lead investor in the transaction. The balance of that we're putting in along with any other investor that wants to invest below $1 million.
Okay, got it. Thank you.
Oh, and return, just to add, return on that is 16% IRR, and there's a 10% preferred return to investors.
Okay. And what's your estimated life cycle of the investment?
Our typical will be, we'll target deals that are 5 to 7 years. This particular deal affords us an average cash flow of about 7.6%. And so because of the loan assumption on this deal and the interest only period, for 10 years, we're targeting a 7 to 10 year hold. If necessary to exit at 7, we can exit at 7, 9, or 10, depending on the sentiment of or key larger investors that are involved. But and also the decision to leave some meat on the bone for a new buyer that comes into the transaction. The loan itself matures in 2034, but it's got a 10-year interest-only period remaining on it, so it gives us a significant period of higher than average cash and cash return.
Okay, very good. Well, thank you. Any other questions?
That's it from my side. But I think that, of course, you might have more questions coming in from the investors and attendees up to the conference. As I said in the very beginning, we have recorded the whole conference, the whole presentation, so that people who are not able to join us in real time will receive that tomorrow bright and early in the morning, and are going to be able to go through all the presentations once again. So you're going to have more interesting conversations afterwards as well.
Okay, well, thank you, Olga. And for the attendees, what would they do to get more information about a particular company they have an interest in learning more about?
Yes, very good question. So tomorrow, everyone will receive the link to the recording as well as the executive summaries or the presentation decks. So that's one thing. But if you want to get an introduction personally to any of the companies that presented, you can contact me directly. I'm going to share my email with you in the chat right away. And also, of course, we have many more conferences such as this one coming up this year. So I'll also send you a link where you can keep track of those, stay updated, and hopefully join us in the future.
That's right. Thank you. And we expect our next real estate conference to be in April, I believe. We have yet to set a date.
On a quarterly basis.
Yes. Okay. Well, that's all I have. Olga, anything else? Any last minute thoughts?
Yes, well, of course, the most important thing, I want to thank everyone who attended today, all of the presenters, of course, who took their time to prepare those great presentations and to answer all the questions that we had and that the audience had. And of course, great thanks to the audience who has been with us. Of course, thanks to the participants who stayed with us until the end. But in any case, as I said, the recording is going to be made available. So those that were able to stay only in the beginning are going to get to see all presentations through to the end. So thank you all. And we really hope that you're going to be able to join us in the future. I think me and Steven are going to stay here tuned in for a couple more minutes to let everyone, if you want to exchange your contact details once again in the chat, or share any last minute information, and then we're gonna log off in a couple of minutes and hopefully see you soon.
Well,